July's mini masterclass Thursday. We are once again only going to have one mini masterclass this month. We only got one in June. We will only have this one in July, but we are here and we are very excited because this topic is really near and dear to my heart. I've actually created an entire workshop series around this topic. So we're going to go over the basics today, and then I'll give you some more information on how you can get even more information. It is July 10th, so happy belated 4th of July to everybody. I hope you all had some fabulous times with friends and family. I got to go camping and get out in nature, so that was perfect for me. All right, so getting on to our topic this month, it is financial literacy. So financial literacy is commonly misinterpreted as just one thing or one meaning like, how to do investments or how to do wealth management. And that is definitely not the only thing that financial literacy means. In fact, there's so many things that you need to know to be financially literate. And that's what most business owners struggle with, is that they don't know what they don't know. And therefore, if you don't know these things and you don't have anybody guiding you and telling you about them, you are not financially literate. And even if you know how to balance your checkbook and how to read your P&L, that does not make you financially literate necessarily. So today we're going to go through the very basics around what it means to be financially literate and the things you need to know and do to put yourself in an advantageous position around financial literacy. All right, so first and foremost, entity structure. This is so important. And this is something that even I, when I was a brand new business owner over a decade ago now, did not know anything about. I had worked in corporate America for over a decade. I had actually had my own kind of side hustle businesses as well, but no conversations ever were around entity structure and entity selection. And when I got into business, I learned it by going and taking classes around how do I help my customers better understand their numbers. Therefore, I learned how to better help me as well. So don't feel bad if you don't know these things. There is no shame, there is no guilt, there is no nothing around I should have known this, or I wish I would have known this. Well, everybody wishes they would have known this, but it's also why we're bringing it to you and to our audiences across the country, because we understand that nobody's telling you most of the time. Hopefully, you're working with a very good tax preparer who does tax planning, who does education, who looks out after the health and wealth of your business and personal financials and all of that. But it's very common to get a tax preparer that's just like, give me your numbers, I'll put it in a system, I'll slap a tax return out for you, and then we're done. And that is extremely common and unfortunate. So I'm hoping to give you tools through things like this and our workshop series that will enable you to ask questions about things you didn't even know you didn't know, and therefore get the help that you can get to put yourself in a better tax position legally and very above board. So entity structure. There are several different types of entities. I'm going to just go over the most popular ones right now. There's a sole proprietor, which is the basic. It's just you, owner operator. You might even not even have an EIN. You transact under your social security number still. All good, nothing wrong with that. You're going to pay the highest amount of taxes on your profit, period, as a sole proprietor, which is why, one of the reasons why you want to get away from being a sole proprietor sooner than later, fast as you can, really. The other reason is that as an LLC, you start having asset protection that separates you as an entity from your business. And so that may be something important to you right off the bat, where you don't even want to do sole proprietor ever at all. You want to go straight to LLC for that asset protection. When I started a business, I didn't really have any assets to worry about. So it wasn't something I like, again, knew to think about or ask questions about or be educated on. But as I learned more and more over time, when you gain assets or when you have more assets, you definitely want that protection, right? So of course, then that means the next step is LLC. LLCs can either be single member or multi-member. Single member, again, it's just like you're a sole proprietor still, but you have that asset protection. As a multi-member LLC, multiple members have their taxes based on the profit of the company, but also the asset protection. So it depends on how you want that, or if you have partners in your business. Now, an LLC can also elect to be taxed as an S Corp corporation. This means you are still the entity type of LLC for your asset protection, but you get the tax advantages of being an S Corp officer instead of paying as a member for your LLC. That is very good if you're at a certain point in your business. You don't need to do that until you get to those certain points, because once you elect the S Corp election, or once you form an actual S Corp or C Corp proper, you now have to do two tax returns. You have to do your business tax return, and those are due 1 month before the personal tax return deadlines, and you have to do your personal taxes. Does it then make sense to do two tax returns, pay two tax returns, and are you saving enough to make that worth your while? That's what you would want to sit down and talk to someone about if you are considering taking the S Corp election. Does it apply to you? Do you need it? Is it going to do you any good? Those are conversations we can and should have if you don't know about this information and you have no one helping you with that currently. So then, of course, you can have an S or C Corp proper, which means your entity is a corporation, not an LLC, but an actual S corporation. And then you have to follow the corporate compliance guidelines. And this is one of the biggest mistakes I see people make, is that they take the LLC, or they have the LLC with the S Corp election, or they are an S or C Corp, but they still transact and run their business as if they were a sole proprietor or a single member LLC. You cannot do that once you take the S Corp election or form an S or C Corp proper. You then have to follow corporate compliance. What that looks like very broadly, very generically, is you have to pay yourself on payroll. You cannot just take draws anymore from your business, which means you're paying into your payroll taxes correctly and not just being taxed on the profit at the end of the year, but you're additionally being taxed at the profit at the end of the year. So there are tax planning strategies where you kind of zero out your profit and you don't pay more in taxes. As well as you have to have things like an accountable plan in place, which allows the corporation permission to pay back you as an officer for any personal expenses that you may have incurred, or personal spending you may have incurred on behalf of the business. If you don't have these things in place, then technically you cannot take money out of the business, because once you become a corporation, elect or proper, you are now a completely separate entity from your business. You do not, it is not your money anymore. It is your business's money and the corporation's money, and you are getting paid from the corporation. You are not the business any longer. So that's part of why you have to do these things. And there's a lot more information. We go into so much more depth in our workshop series. So if this is something that is like, oh gosh, I don't know if I'm doing this right, I encourage you to do more and take more education, but I want to give you the basics here. So once you're a S Corp officer, you have to pay yourself a minimum of reasonable compensation. Reasonable compensation is an IRS compliant test that you take that shows all the different facets of your business, the location, the time you put into it, the duties that you do, and or the duties that everybody, all the other officers do, because you might have someone that's like 90% active and doing 90% of the work, and someone else who's just kind of an investor silent partner. Their reasonable compensation is going to be a lot lower than yours because you're doing all the work. What reasonable compensation is meant to do is pay you what you would have to pay someone else to step into the role that you're actually performing in your corporation. And I know most owners are doing all the hats. They have 50 jobs that they're doing. They're multitasking all the time. What would you have to pay somebody from the street to come in and do what you do for your corporation? That is what reasonable compensation ends up resulting in. And what we do is we actually use the IRS test specifically so that if you're audited, there is no problem with how you came up with your reasonable compensation. You are able to say, this is what I did. I followed all your guidelines. I did your test, and this is what it said I had to pay myself, and this is what I'm paying myself. Easy peasy. Now, as an S Corp officer, you are also allowed to take distributions. Distributions mean that you can take money out of your out of your business and only pay the state and federal taxes, but not pay the Social Security and Medicare taxes that you normally have to pay as an employer that match. So it's a tax savings strategy. You don't have to pay those additional taxes, but if you have not met reasonable compensation for the year, you cannot take those distributions and you cannot take that tax savings. And I see a lot of people pay themselves like just a little bit and then take all these distributions. And that's such a big red flag. And there is a new tax standard for preparers that if they file a tax return that does not meet reasonable compensation compliance, they can actually get audited or fined up to $5,000 per tax return. Therefore, tax preparers are not going to want to keep doing the, oh, sure, I'll just put it in and make it work. They're going to need to really be compliant, which means you're going to need to be compliant in order for you to find somebody to file your tax return. It should be a gigantic red flag for you if your tax preparer is not concerned about compliance. Because ultimately, the burden of proof, the onus is on the owner of the business, not the tax preparer. Now, yes, they can get fined. Yes, a CPA can get investigated and maybe, lose their license over time, but you still have to then correct their mistakes by paying out the penalties and the interest and everything else that you may be liable for if this isn't done properly. So it doesn't matter that they can get in trouble because you still have to come up with that money. If the IRS deems that you weren't paying yourself reasonable compensation and then reevaluate your distributions that actually should have been payroll, which can happen in an audit. So it's actually really important. Now, as a C Corp officer, you actually cannot pay yourself more than reasonable compensation. Whereas an S Corp officer, you can pay yourself all you want, but you have to pay a minimum of reasonable. So there's some different parameters for the different corporate types. And again, definitely have a conversation with the tax preparer around which entity type actually best suits you from a strategy standpoint, a financial standpoint, and a tax standpoint of what you're doing in your business. So that's entity selection. You want to definitely, you can go from sole prop to LLC taking the S Corp election, or you can go from sole prop and start a whole S Corp from scratch or C Corp from scratch after you decide to no longer transact as an S Corp. Or you can go from an S Corp, sole prop to an LLC and leave it there forever. So, or leave it there, and then when you're ready, take the S Corp election. So you can do this in tiers as your business grows and progresses. And that's why it's really important to have an accounting professional in your corner watching out for the signs and cues that it's time to move into the next entity to save yourself tax money. At the end of the day, if you don't care about asset protection and you don't care about paying the maximum amount of taxes a human can pay, then you can be a sole prop forever. That's the end of the day on that one. All right. So next we're going to go down the record keeping talk. And obviously that's what we do. We do all record keeping, bookkeeping, accounting for our customers, but you really, really, really want to make sure that if you're not having somebody manage this for you, you are having clean, accurate books. I have seen very recently several audits start happening that are not even bookkeeping or accounting related. They were employment related, as a matter of fact. Both of them, ironically, two completely unrelated companies, both are in unemployment audits because they had disgruntled employees who said, oh, I'm not getting my overtime, or, oh, they didn't pay me my final check, or whatever it was. So they went to the Department of Labor, they complained. The Department of Labor then starts investigating, and it ends up in a unemployment audit. The unemployment audit in both of these cases has uncovered all kinds of accounting faux pas, we'll say, that are resulting in a bigger and bigger and bigger fine that's coming down the pipeline because one entity or agency leads to another agency's compliance, leads to the other agency's compliance, and they are finding all of it. Because when you're audited for anything, they're asking you to turn over your entire general ledger, which is then showing up all kinds of different information. And I'll give you the example of the worst of the two. Unemployment wanted to make sure that this person was paying his payroll taxes because employees stated that they didn't think that they were getting paid. Being withheld, yes, but not getting paid. So they filed a complaint with the Department of Labor. Department of Labor goes, okay, I want to see all your wage history reports and your general ledger so that I can confirm that payroll checks have cleared the way that they're reported. Well, in the meantime, he's asking to see the W-9s for all of the vendors to prove that these vendors actually qualified as vendors and they should not have also been on payroll. So now you have W-9 compliance errors because the W-9s were never issued. You also have, which means the expense that this person spent to pay these vendors has now been reevaluated as no longer a business expense because he does not have the proper documentation to prove that these vendors qualified as a write-off for the business. Now he has increased taxable liability that he hasn't paid the taxes on because he took it as a write-off without having the compliance, which is now reassessing back owed income taxes, penalties, and fines. On top of that, they have found that the owner officer did not pay himself reasonable compensation because it's nowhere to be found in the books or in the payroll reports, yet did take a significant amount of distributions, which he did not pay payroll taxes on, therefore have reevaluated those distributions to meet a minimum of what they are deeming reasonable compensation, which, by the way, they're using the same exact test that we issue. So that proves that it's a worthwhile activity for you to do. Then whatever is left over from the difference between what he took out and what reasonable should have been is going to stay a distribution, and the rest is reevaluated as back payroll. He has to come up with payroll taxes, penalties, and fines on everything he didn't run through payroll from not paying himself reasonable compensation. And he has a whole bunch of ATM and cash type transactions that have no receipts, no invoices, no backup. He has checks that were paid to employees for reimbursements, which is correct, but not the reimbursement backup, which now means he should have run it through payroll as far as the agency is concerned, and they should have paid payroll taxes, and they're treating it like it was a bonus. So he has to come up with those back payroll taxes since he couldn't prove that the reimbursements were for materials, fuel, and things like that. All of that because of a disgruntled employee, not even because his tax return was wrong or anything about it, his accounting was a red flag. That just goes to prove if you don't have good records, if you're not doing the things the way you're supposed to do them, compliance wise and record keeping wise, you will be screwed in an audit. And as an accounting professional that helps businesses really run their business, not just data enter numbers, we are constantly looking out for the compliance of the business as well as just getting the numbers, which means we're asking for the receipts. We're letting you know you have to have the W-9s. We're collecting them on your behalf. We're looking through your vendor agreements to make sure that they're compliant for the agency of the state that you're in. We're letting you know, hey, based on your reports, you should probably take the S Corp election. You're going to save like $30,000 in taxes. We're doing business strategy with you. We're helping you budget. We're helping you hire and fire. Those are all things that most business owners don't really understand how to do right off the bat. And over time, they learn either by default, making a mistake that they have to clean up, or somebody finally coming in, or by reaching out and getting education. So make sure your record keeping is clean and accurate. Take it seriously. It does not matter if you're a little business, if you're a sole proprietor, if you're an owner operator, if you have employees, don't have employees. It doesn't matter as far as the IRS is concerned. When they audit you, they want proof of the source documents that prove that the numbers you reported on a tax return, remember I said you, not your tax preparer, because the onus is on you to have approved and understand what was reported on your behalf by a tax preparer and confirm the legitimacy of it. So when you're audited, they want to see source documentation. That means the receipt, the invoice, the contract, the W-9, the 1099, the anything that resulted in the reason why you called this thing a write-off. And therefore, if you don't have those things, you're out of compliance. You can't, your entity structure, so we talked about the entity structure, that can actually be reassessed if the IRS or state comes in and feels like you're transacting as if you're still a sole proprietor. So you're not following the compliance part of things. You're just willy-nillying it and taking all the advantages, but not following through with the compliance. So they can reassess your entity structure even, and all these taxable write-offs can be reassessed as taxable income to you, which means if you've received any tax benefits from having been a different structure than you are reassessed as, you have to pay back taxes and penalties and interest on those additional taxes that will be assessed when they do that. It can go on and on. It can snowball out of control. The most important thing about record keeping to keep in mind is you're not doing bookkeeping data entry. You are putting yourself in a position, whether we're doing it for you, you're doing it for yourself, or a combo of both. You're putting yourself at all times in a position that if you're audited, you have everything you need to get through the audit with flying colors. And you're doing everything you can to be as compliant as possible with the business laws and regulations in your state specifically, because state laws do supersede federal laws as far as things like this. So it could be that on a federal level, A, B, and C apply, but at your state level, they actually want A, B, C, D, and E. And a good example of that is California. It's one of the most aggressive states as far as being not employer friendly, right? On the back end, you have to really follow through with the compliance. So just keep that in mind that your record keeping, if I don't care if you're a one-man band or if you have 50 employees, you need to take it seriously. And from the start, one of the biggest mistakes people make is thinking, oh, it doesn't really matter because I'm little and nobody cares. That is when you are going to get in the deepest, darkest trouble, because you're doing all the things wrong that will be found in the audit. And you don't have the money that you'll have in 10, 15 years from now when you're bigger to pay all these fines and interest. I have seen people have to close their businesses because of an audit or sales tax problem or things like that, where they didn't appropriately divide their money and track where things were coming from. And then at the end of the day, they didn't pay their workman's comp. They didn't pay their sales tax. Those agencies come in, they close their doors and they want all their money before you can open your doors again. And if you don't have it, you're done. So things like that can happen. And little guys, it affects you almost more because you're not set up to really address it when it happens. So take it seriously, reach out, even if you can't afford someone to manage your books for you, you should absolutely, at minimum, be doing tax strategy planning quarterly, minimum, quarterly as a brand new one owner operator, tiny business, it doesn't matter, so that you're at least having someone look at your business from how much have you made so far? What is your anticipated that you're going to make? Let's put these strategies into play. Oh, we should look at this entity. You really start to understand a lot more about the health of your business by working with a tax preparer that does tax planning quarterly so they can understand your business and lead you down the path of success rather than reflex where you're like, oh, if I had only known, I could have done X, Y, and Z. And now it's too late, or now we have to amend, or now I've lost all these tax advantages for last year that I could have taken advantage of, but I didn't know because I didn't talk to anybody. So that's our next that's our next topic is tax planning. So being financially literate has also to do with your tax structure. Your entity structure and your record keeping are two different things than your tax planning, because tax planning takes into consideration investments, equipment, assets, depreciation, future spending, your entity structure, yes, changing or updating, what's updated in your record keeping, equity, transactions. It takes all of the things that are involved in, and sometimes also in your personal life, and makes a plan for how to maximize the potential of your tax savings, or not even savings, but having to pay the least amount of possible because you're taking advantage of all these different opportunities legally, of course. And once again, so I, again, highly recommend at least quarterly, no matter how small of a business you are, because through tax planning, you're going to understand how you should be doing things in the future, how you should be doing things right now, what opportunities are available to you to take advantage of. Very recently, I was working with a customer who did not realize that there was a SEP IRA option available to them, so that when they have this large profit at the end of the year and they haven't had employees for longer than 3 years, they are able to still contribute to a SEP IRA after the deadline, up until the extension deadline, to help give themselves the maximum savings possible of using their profit, keeping their profit in their own hands, and not paying taxes on it. They would have never known that if they hadn't done the tax planning with the tax preparer that we set them up with. They would have paid way more in taxes because nobody was telling them this. Nobody had brought it to their attention. And from a tax perspective, we don't do taxes, so we don't know every little tax thing that there is out there. That's why you want to do this specifically with a tax planning professional, because your accounting professional can help you to a certain point, but then there's other things that are very tax specific that don't even have to do with your record keeping at all. There's nowhere in the record keeping that we put SEP IRA information. That's a completely separate tax only situation. So definitely do that. Last but not least is for financial literacy. Look at your reports. Get educated on how to read your financial reports. Ask questions, have meetings, strategize, get education on what you're looking at if you don't know it. We are not taught in school, unless you go to school to be an accounting professional, or maybe even in business school, what a P&L is, what a balance sheet is, how to read it, how to pick out anomalies, how to do this. We're not taught that. So it is very common that you get this report and you're like, okay, what am I looking at? I see my bottom line says I lost money or I made money. That's what most people think they need to care about. But there's so much more information within those reports. The reports tell you the story of how your business is doing. and when you can hire, when you need to fire, then all the stories you need to make strategic business decisions all laid in your numbers. And if you don't know what you're looking at or how to look at it, you are missing so many opportunities, or you're waiting way too long to make changes that could be detrimental, or you're not taking the time to understand how much you can pay yourself or how you can do these other things, and you're just hurting yourself over time. So get comfortable knowing, understanding, and reviewing your reports. I'm going to say that the guideline is you should do this quarterly at minimum. I don't think minimum. I think monthly you should be doing at minimum. And I can tell you for a fact, even me who does this for a living, once I started committing to reviewing my numbers monthly and creating a budget on top of, so I could review budgets to actuals, which took me several years to actually do for myself in my own business. I'm going to tell on myself because none of us are perfect and we all start somewhere. Once I started doing that, it has made a gigantic difference in my business, in my ability to understand when I need to ebb and flow and pivot and change, and how I go about reaching my goals. Part of being financially literate is understanding how to get from here to here, right? How to go from A to Z. How do I go from mile 1 to mile 3? If you're not looking at your numbers and reverse engineering into that, you're just flying blind, hoping it all works out. And that's not a good business strategy. That's not a great way, and it's not efficient, and it's very frustrating and time consuming. And you can get to where you want to be so much faster if you really do these things up front as early as possible in your business. Now, I understand new businesses can't really budget because it's new. You have no idea. You have no historicals to look at. But you can do projections, or you can do, I would like it to be like this as a budget. I would love if by second quarter we're at this margin. I would love if I could hire somebody by the end of third quarter. So budget for those things and then look at what it's going to take to actually get there. How many units do you have to sell? How many contracts do you have to sign? How many hours is this going to take you to do? How much marketing are you going to do to get the customer base to buy enough things? Like you really want to understand all those numbers, So those are the quick and dirties of financial literacy for Mini Masterclass Thursday. I do want to say that through our consulting and training firm, our sister firm, we like to call it, Simplified Accounting Management, we are offering 2 virtual financial literacy workshops in August. They are August 21st and August 22nd. You can go to our website, saminc.services.com, and sign up for either of those, whatever day works better for you. And then in September, we're offering a full 1-day, all day, 8 hours, financial literacy in-person workshop in Bozeman, Montana. So we have had people fly in. It's well worth your time. You get so much more of a deep dive. There's a workbook. There's really all the information you possibly need to know all the stuff we just talked about and so much more that we can't possibly cover in 30 minutes. So those are coming. They're on our website of our sister company, samincservices.com. I also have this little handout that I am going to link to this mini masterclass that you can download and help just start understanding where you stand with your financial literacy and your understanding, period, of your business health. So I will link this. If you're watching this, even on replay, you'll be able to download that, use that as a tool to help you understand, should I get more information? Do I feel confident? Am I on the right track here or not? So again, 2 virtual events in August 21st and 22nd, and then an all-day in-person live event in September in Bozeman, Montana. Thank you so much for joining Mini Masterclass Thursday. We'll see you again next time. We appreciate everyone who watches us live and comes back for the replay. Reach out, let us know if you have questions. We do check the comments on our LinkedIn, our YouTube, our Instagram, and our Facebook. Everyone have a great rest of your weekend ahead, and we'll talk soon. Bye.